You hear it all the time in the crypto space, right? Backed by gold. It's a common claim, but what does that really mean? Today, we're going to peel back the layers of a project called Goldfish to see what true security for digital gold actually looks like, from the corporate filings all the way down to the bedrock itself.
And that's really the core question, isn't it? Especially with digital assets tied to real-world things, trust is absolutely everything. It's not just about someone making a promise, it's about having proof you can verify. And that proof, as we'll see, is built in layers.
So let's meet Goldfish. At its heart, it's a digital token that represents ownership of real gold. The whole system is designed around these three pillars: security, liquidity, and transparency. But how does it actually pull that off?
Okay, so here's how it works. Each one of these Goldfish tokens is pegged to a tiny fraction of a troy ounce of gold, and it's fully collateralized. But here's where it gets really interesting. The collateral isn't just a bunch of gold bars sitting in a vault somewhere. It's actually another token, a security token called ion.au, and that token is backed by verified gold reserves that are still in situ, which means they're still in the ground. And securing that claim is where this whole story really begins.
So let's peel back the first layer of this security onion. And you might be surprised because it has less to do with crypto and a whole lot more to do with good old-fashioned corporate structure and accountability.
The entire asset that backs Goldfish ion.au is housed inside a publicly traded company called Ion Digital Corp. So right off the bat, this isn't some anonymous, shadowy project. It's a real entity that's listed on a public exchange. Okay, but you may be thinking, why does that even matter? It's a public company. So what? What does that actually do for the security of a digital asset? Well, the answer really boils down to one thing: radical transparency. Public companies can't just make claims. They have to prove them. They're subject to regular, audited balance sheets, and they have to follow incredibly high standards for financial reporting, using the same strict accounting rules that regulators like the SEC favor.
And here's the key. The specific method they use is called mark-to-market accounting. Instead of valuing assets at whatever they were worth when they were first acquired, MTM values them at their current market price. Now, for a fluctuating asset like gold, this gives you a real-time, totally transparent picture of its value. It's pretty much the gold standard for this kind of thing.
And we're not just talking about one local standard here. The company complies with major global frameworks like US GAAP and IFRS 9. This is the kind of institutional-grade compliance that big banks and funds look for. It's the bedrock of trust, but it's only layer one.
All right, so we've got corporate transparency locked down, but what about the gold itself? This brings us to the second layer, the actual legal mechanisms that put a lock on the physical collateral.
Before a single ounce of gold reserve can even be considered as collateral, it has to pass this proprietary and frankly extremely rigorous 40-step onboarding process. This is no simple check-the-box exercise. It's a complete, exhaustive deep dive.
The whole process really breaks down into 4 key stages. First, they verify the heck out of the asset owner. Then they do a deep dive into the legal and tax history to make sure ownership is crystal clear. After that, they bring in independent geologists to verify the amount of gold in the ground, using really strict industry standards. And finally, the most critical step of all, they perfect a legal lien on the asset.
So what is this thing, a UCC1 lien? Well, it's a standard tool in the world of finance. It's a public legal notice that says, hey world, I have a security interest in this asset. It gives them a secured claim, basically like planting a legal flag on that asset for everyone to see.
Honestly, the best way to wrap your head around it is to think of a mortgage on a house. The bank puts a lien on your property, right? That gives them a legal right to it if you stop paying. The UCC1 lien does the exact same thing for these gold reserves. It's a powerful, legally enforceable lock on the collateral.
Okay, so a public company, a legal lock on the asset, that's already pretty powerful. But when you're dealing with commodities, with all their volatility, you need an even bigger safety net. So let's look at the final layer of protection.
I mean, think about it. Having a legal claim on gold that's still in the ground is one thing. But what happens if the price of gold suddenly tanks? Or what if the mining process doesn't yield as much as everyone expected? You absolutely need a buffer, a cushion, to absorb those kinds of shocks.
And that buffer, well, it's not just a small cushion, it's massive. We're talking a 5-to-1 ratio.
So what does that actually mean in plain English?
It means that for every single ion.au token issued to back the Goldfish stablecoin, there are 5 ounces of verified, legally secured gold reserves sitting there backing it up. This is extreme over-collateralization, and it's designed to provide this huge safety margin against almost any kind of market or operational risk you can think of.
So, when you put it all together, you've got these layers, the corporate transparency, these legal locks, and then this huge safety net. What you end up with is a system that was clearly built with a very specific philosophy in mind.
And this is maybe the most important takeaway of all. This system wasn't just cooked up by some crypto devs in a garage. It was architected by applying the same time-tested principles that bankers and financial institutions have been using for decades to secure assets and manage risk.
Just look at this comparison. It's almost a one-to-one parallel with a commercial mortgage. In both situations, you've got a valuable asset, a building or gold reserves, and you use a legal lien to create a secure, enforceable claim against it. It's the exact same logic, just applied to a new kind of asset.
At the end of the day, what all this does is create a product that traditional financial institutions can actually understand and trust. It functions just like a standard asset-backed security, or ABS. The collateral is real, it's legally enforceable, and the entire structure is built from the ground up to be fully compliant with existing banking and securities laws.
Which really brings us to the final big picture question. By taking the trust, the legal frameworks, and the risk management of traditional finance and plugging them into a digital asset, are we seeing the blueprint for a bridge that could finally connect these two worlds? That's a pretty compelling thought to end on, isn't it?